We've got breaking news from Eric Balchunas at Bloomberg on X moments ago, which we're recording on Monday. But starting tomorrow, Tuesday, Vanguard will allow ETFs and mutual funds and select other cryptos in addition to Bitcoin to begin trading on their platform. They cite that the ETFs have been tested. They performed as designed through multiple periods of volatility. This is the hurdle rate for the week of December 1st, 2025, episode 38. The incentives are aligned. I'm Tim Kotzman. I'm here with Ben Workman and Jeff Walton. Ben, we were talking a little bit before we started. The incentives are aligned. What are your thoughts?
They are. I mean, you know that it's all going to be driven around the economics of these products. As soon as most of these exchanges, when they were giving all the ETFs the stiff arm right out of the gate, and investors were having to call in and write letters and try to apply pressure, over time, success is going to break down all the barriers to entry. And that's what you're seeing right now with the ETFs. You can't have a company like BlackRock that issues an ETF like IBIT, and it becomes systemically important to them as a company, and every other company's going to sit on the sidelines. It's just not going to happen. There's money to be made. There's fees to be collected. You're losing assets from customers who want to go out and get exposure to these products. The pressure really does add up over time. Now, we could look at the timing and go, wow, this is pretty curious timing, because now they're allowing their investors to get in after this major drawdown has already happened, so great timing for them to start being able to get access to this. But I was always of the mindset that this was simply a matter of time. You can only be ingrained in being the opposition to these products until they reach so much scale. And at that point, they become undeniable. There's demand, and the investors want them. And because of that, you're going to have to give them what they want. Otherwise, that capital is going to be moving to other platforms. So, I think this was inevitable on a long enough time horizon. Give Vanguard credit. They fought the good fight for a while, I suppose. But in the end, all roads lead to Bitcoin, and Vanguard's the latest one that we see breaking down on that front.
Yeah, and this is coming off the back of last week. BlackRock says Bitcoin ETFs are its top source of revenue. You know who likes money is the people that manage the money. So the incentives are aligned, as you pointed out, Tim. BlackRock, for reference point, has about $13 trillion in assets under management. Vanguard has about $10 trillion in assets under management. So you've got now more capital that's opened up and potentially able to buy the Bitcoin ETF. The other thing, I was chatting with my father-in-law over Thanksgiving break just about Bitcoin, just the landscape. He's got a bit of a finance background. And we were just talking about just the dynamics of ETFs and how they work, and the structure of the plumbing. And as somebody that's selling these instruments, or if you're somebody selling the Bitcoin ETF in the market, the easiest product to sell is the best performing product. That's all you have to say. Hey, do you want, hey, I noticed you don't have any Bitcoin ETF exposure in your portfolio. This is the best performing ETF in BlackRock's history, the fastest performing asset to $100 billion. I think you should consider a 1% allocation. It's pretty easy to sell the best performing asset on the planet. And if the incentives are aligned and it's the biggest revenue generator for all of BlackRock, there's incentive to go sell more of that instrument. So I think we've just seen the beginning of this, and I think it's going to continue to expand and explode, especially as you open up different capital pools to, these types of instruments.
Yeah, you can understand the hesitancy in the early days. Obviously we're all Bitcoin bulls, and we've been following Bitcoin for a very long time. We understand Bitcoin, but when you look at traditional finance, this completely upsets the models that they used to have. So for these larger institutions to be unwilling to move Bitcoin products into their ecosystem, if I put myself in their shoes, I can understand it in the early days. But when you start to see an asset become a multi-trillion-dollar asset, and it's now competing for size with precious metals like silver and jumping over it, and then silver passes it. But when you see that type of adoption, and when you see the speed of adoption and the type of entities that are adopting it, I think that over time, you have to see the legitimacy behind this asset. It's so ingrained now in the financial system. It's gotten talk from the politicians, and the administration's been very favorable to it. You've got central banks that have adopted it now, or at least put it on their balance sheets. And I think that all of those items slowly over time, the arguments against the legitimacy for Bitcoin have just fallen away. And at that point, you're almost looking foolish to sit on the sidelines any longer than you are. Right? It doesn't mean that the asset's going to stop being volatile. We're seeing that right now. That part of Bitcoin is not gone. I think people thought it was gone for a while. There were even moments where I thought, well, maybe it's just going to be a slow grind up and to the right. But the volatility is still going to be there. But the demand is also there for those products. I think that the noise around the management of fiat currencies is getting louder and louder every single year. And because of that, the message around Bitcoin is getting amplified more and more every year. And at this stage, it just is becoming a part where even if you're just purchasing it as a hedge, it has to make its way into portfolios. And I think you're starting to see that. I think investors were starting to demand that. And now they've got the access to it. This is a really big platform for this to open up. And so I'll be very curious to see what that does when we start looking at the ETFs and the volumes coming into the ETFs here over the next several weeks. I'll be curious to see, what type of pent-up demand is in Vanguard versus what's already left. So this could be a fairly major inflow given the size of the assets under management that they have.
Yeah, I was just thinking that if it's 13 trillion and 10 trillion, then, maybe not double, but theoretically, couldn't those inflows double from 100 billion at BlackRock to, another 100 billion through the Vanguard platform, or is that too bullish? Separately, but also together, why is it that gold and even silver is like just ripping? And what does that tell you guys, especially with today being the last day of QT? Just like bullish. I'm like bullish. I'm going down my list.
Yeah, I think the main differentiator, right, is BlackRock's the issuer of the ETF, but it's being sold through all the other brokerages, right? So the capital's coming in from multiple places, and demand has just largely gone into the BlackRock product out there. So this is just one more entry point for that product, but this one happens to hold significant assets under management, so you could see quite a bit more demand. I don't know what that's going to mean overall. Nobody does. So we'll have to see what those inflows look like, but got to imagine it's not insignificant. There's a lot of people that really do trust Vanguard, and they're willing to keep their capital there, even if they were denied a product like this. A lot of people do not like to move brokerage accounts and roll them over to other brokerages. It's a real hassle to go down that path. And Vanguard's been a very trusted name for a very long time. So I would imagine a lot of capital stayed despite the fact that they wouldn't give them access to Bitcoin. And that was likely very painful while Bitcoin was at 126. And then when it draws down, they go, well, I guess I didn't have to take that ride. So we'll see. We'll see what happens. I'm pretty positive on the outcome here. I think there's probably going to be a fair amount of demand that comes out of Vanguard into these ETFs, but time will tell. But it is very curious that timing, right? Bitcoin's down. You got the end of QT today. Vanguard comes out and says that JP Morgan had launched their product earlier this week. There's a lot of things happening in here to kick off December. So it's not going to be a month where we're bored. That's for sure.
The incentive alignment for these institutions to help with how rating agencies view these products as well is also there. So thinking about banking Basel rating frameworks or insurance companies being able to hold this instrument and be able to lever against it, there's incentive for those institutions to work on also unlocking these additional pools of capital into the future so they can purchase these instruments because they are the biggest revenue generator. They are the best performing ETF on the planet, et cetera. So yeah, it's a lot of excitement to, watch this all unfold. I think we've been talking about this or we might have even brought up Vanguard in one of the very first hurdle rate episodes was, you're ignoring this asset class, and we view this asset class as the hurdle rate. It's like the disconnect is so stark.
Well, what was so interesting with Vanguard was you saw the ownership in all of the treasury companies. They were a major holder. or Strategy, several others. And so it's clear that there was demand in the sector for the capital that was there, but it just didn't have the access to the ETFs. And so now we'll see what that looks like. But it's a full circle moment here. They were the one that was very staunchly opposed. And now I'm going to be curious because all the headlines I'm seeing say that they're going to give access to crypto ETFs. And so for as cautious as they've been to even dip the toe into Bitcoin, I'm going to be curious if this truly means that they're just going to give access to the majority of these crypto ETFs as well that include a lot of the assets outside of Bitcoin, or if it's going to start with Bitcoin. I haven't seen anything that tells me one way or another yet, but seeing the word crypto leads me to believe it's broad.
Do you guys want to talk about the arguably the other leading story of today, MSTR literally establishing a USD reserve, dollar reserve? I mean, that's just
USD reserve. Yeah,
I think there's a lot to unpack. A lot to unpack there. Yeah.
Yeah, it's the green dot that everybody was speculating on Sunday. What if we added green dots? And I think this is great news for the entire ecosystem. I think this quelled a lot of concerns for the common stock shareholder. It's there's been a ton of noise on X and people that view this in two different ways. There are people that view this very positively. There are people that view this very negatively, and that's periods where I've seen that type of sentiment shift is when there's been the most volatility. So I'm interested to see how this really shakes out here. But one of my biggest takeaways from one of my biggest realizations with Strategy adopting this USD reserve is that the S&P, when they gave them their issuer credit rating of B-, gave them zero credit for the $60 billion of Bitcoin that they held on the balance sheet relative to their $8 billion of debt and their $7 billion of preferred outstanding. Okay. Now, USD, $1.44 billion USD reserve is now been established. And so from S&P's point of view, Strategy has gone from having 0 months of dividend coverage to now, 18, 19
21
months. Yeah, 21 months of dividend coverage. And that should significantly impact how the rating agencies view their relative balance sheet. So it's a significant change in the technical credit rating from assuming that the value of the Bitcoin capital is worth 0. So the other fascinating part is that they've established this USD reserve, which would cover 21 months of dividend obligations. And they did it in 2 weeks, utilizing the ATM in 2 weeks in a period of Bitcoin weakness, which is just an incredible feat, recognizing that the price of Bitcoin's down, price of MSTR has been down, and they're still able to raise a significant, $1.44 billion of capital to give them 1.75 years of runway without using the common stock ATM at all in the future to pay those dividends. So yeah, I think it's a fantastic, I think it's a smart move. They followed somebody else in the space in establishing a cash reserve to pay dividends. So that's fun to see.
Yeah, they actually put the metric in the deck. They raised $1.44 billion in 8.5 trading days at 4.6% of trading volume. So, there was always the discussion, which seemed silly, about whether Strategy would be able to fund the month-to-month dividends using the ATM. And I think part of that is just because when you're hearing numbers, that are tens of millions of dollars in any given month and at quarters, $100 million plus, they sound massive until you look at the volume profile around that common equity, right? It's incredibly liquid. There's a huge amount of trading volume in that stock every day. And so this shows it, 1.44 billion in 8.5 trading days at 4.5% of trading volume, which in the ATM world is not a massive amount of selling during a period like that. was pretty impressive. And I think that when you look at this, it's very polarizing. You can see that on X very clearly, that this decision, and you've either got people who are completely championing it, believe that this was the right move all along. And then you've got the other team that I think was aligned with what Saylor would say in the early days, which was if you have a cash reserve, you're short Bitcoin, right? That used to be the position. But I think the acknowledgement here of establishing this reserve is that their business has evolved greatly over the last 12 months. You know, people, it seems like so long ago that the first pref got launched, but that was only what, 9 months ago? That the very first one ever came into existence, the first digital credit product. And so over that time period, as they've scaled those obligations and those dividends, and then they've pursued these credit ratings and gotten the feedback from the agencies, and they've heard concerns from investors, and you start to see, what people are pushing on in the analyst reports with where they see weakness in your business model. To me, this signifies a maturing in the space in a pretty significant way. This is a focus on the credit quality of the company, and having a reserve like this takes out the anxiety around what happens during a bad month or a bad quarter or a bad year. Because when people could only focus on the common stock ATM as the lever to pull in order to meet these obligations, which it wasn't, but that was the conversation that was happening, you were only ever one flash crash in Bitcoin away from what people viewed as the inability to meet the obligations, right? That was the mindset that was out there. So doing this makes the message very, very clear. They can withstand an extended bear market now without missing a single dividend obligation. But in the presentation, it sounds like they're targeting a minimum of 12 months of dividend coverage, and the initial coverage, they're looking to go up to 24 months, so they'll have 2 years worth. That's half a Bitcoin cycle right there, 2 full years of dividend coverage. And I think that it just changes the talking points, where instead of having the fear out there that it's impending doom month to month, which was nonsense from the beginning, but now you can't even make that argument because they're fully covered on all the obligations, and they've just de-risked this entire play in a big way. And Saylor was very clear when they were on that call, or maybe it was Fong that said it, I can't remember exactly who, but they said, we are a digital credit issuer. That's what we do as a business model now. And so they're structuring the business around that. They're maturing. They're finding ways to reassure the market that they have strength on the balance sheet in a way that people traditionally understand, right? This even shows strength to people that don't understand the Bitcoin side of the business, but they do understand what $1.44 billion means. And so I think that what you're seeing is the culmination of all the feedback that they've seen in the market. I'm sure that, they were looking at what the response would be when, we had a reserve, and you're getting feedback in real time. And as you're going through this process, you're getting feedback from investors. And ultimately, they made the decision that they believe, shored up the model for them, makes it very simple to explain now. The question of where are the dividends getting paid from right now is not a question, right? This means that they don't have a requirement to use the common stock ATM when it's not advantageous to them now. They've got the dividends here for a long time, so they can now focus on executing and scaling the prefs and getting some of that noise. This will create short-term noise around the ATM, obviously, because it sounds like a massive amount of capital to raise through an ATM in a very short period of time, but relative to their scale, it's really not. But from here, now the bear case is you've got to shift your timeline for impending doom out a couple of years. So, it's going to force even the bears to be focused on the long term instead of the short term now, which I think is an excellent move.
Yeah, they did years of work in 2 weeks. They did years of dividend work in 2 weeks. I really like how Saylor presented the image of this rocket ship, and referred to the USD reserve as a battery. He went full engineer mode and started thinking about, okay, this is the battery that we have in case we need to use it. It'll be interesting to see how they utilize that reserve? Like, do they use it? I mean, if the common stock continues to perform well and it trades at a multiple, maybe you just keep the reserve as a reserve, and you continue to just do business as usual, as you would have done if you didn't have a reserve. But now you just have this reserve there in case, one, for multiple different reasons, rating agencies' perspective, investor comfortability, credit quality, the risk metrics and the risk mechanics for all of the preferred instruments. I mean, this fundamentally changes the risk profile of the preferreds. Like, even the credit model, the strategy's got on their website, is like, that model's broken because it factors in really just purely BTC volatility and BTC ARR. Well, now you've got this new element of, a 2 years of dividend reserve. And what if you deplete the dividend reserve in the periods of volatility within your model? Like, the risk on these preferred instruments just dropped drastically. Like, probably, I don't know the exact mechanics. I mean, it's a sophisticated model and it could be more sophisticated, but the risk profile of those instruments has now shifted and changed drastically. So I think Strategy might be the most solvent, transparent company in the entire world, aside from maybe Berkshire Hathaway. Like, you think of like fiat denominated system, but based on the balance sheet and how much Bitcoin trades and how much Bitcoin they've got on the balance sheet and, the future trajectory of this, they are far more solvent than like insurance companies that are 400% leveraged and making 6% margins a year. Like, they're far more solvent than most banks and credit unions when you start to dig under the curtain a little bit. So it'll be interesting to see how this narrative evolves. There's some bears on both sides. There's people that are bullish on this, but ultimately, I think this is going to really solidify the story moving forward. Like, they can weather any storm because they've got the money.
And for scale, relative to their size, it's not that large, right? It's 2.2% of enterprise value. It's 2.8% of the equity value. It's 2.4% of their Bitcoin value. Like, this is relatively small, I believe. And I'd have to look to confirm, but I think like Metaplanet's income generation business, which is where they're selling the options to generate the premiums, I think that's 5% of balance sheet, I think, is what they're kind of holding off there. So you could kind of view that as, a cash holding at any given time on Metaplanet's side. And so, 2.2% is pretty, or 2.4% of the Bitcoin value is pretty minimal relative to the size of the enterprise, but it just provides that next layer of stability here that I think the market was looking for. And it was a whipsaw trading day for them, right? You saw them pull way back early on and then, close down, down 2.5 or something like that. It came back quite a bit during the day.
Yeah, it was totally a whipsaw trading. It was fascinating. I didn't see how the preferreds finished the day, but I would have thought that the preferreds would have just gone vertical, but they really didn't. They're all red on the day, which is fascinating because the risk effectively fell significantly. So that leads me to believe that like the market isn't pricing these on risk. Really? I'm not sure. Again, it will be interesting to see how that plays out. But I'm sharing my screen. Can you guys see it right now? This our strategy to fund USD reserve, and I love that they came up with new terms, and look forward to using these in the future as well. BTC escape velocity. So basically, Bitcoin needs to CAGR at 10.3% into the future for this business model to work. Like, they just, I guess the composite interest rate of their entire balance sheet, I think, is around 10.3%. So if it's over 10.3%, this model works into perpetuity. The cruise speed is interesting. If Bitcoin compounds at 1.4% or greater, they could pay their dividends forever, which is fun math. Like, just to wrap your head around that. Like, 1.4% is what is that, 5.5, 6.5% less than the money supply growth in the US. So you think there's probably a good likelihood that the asset grows greater than 1.4% over time, unless something like fundamentally breaks or technology shifts or changes, or I don't think so. And then BTC stall speed, which is looking on a 10-year basis. So they would need Bitcoin to go down 19% compounded annually every year for a decade in order for the assets to be worth less than the notional debt and preferred that they have on the balance sheet. So
Yeah, I think that brought them down to 1x coverage, right?
1x coverage. Yeah. And yeah, these are crazy numbers. Like, this is incredible solvency. This is good math. And coming off the weekend too, we saw the video of Elon Musk talking about Bitcoin being energy money. It's like, well, this is the reason I like Bitcoin, because it is, bound by energy. Energy is the currency. And if more people start to take that perspective of this, Bitcoin being energy money, the most efficient store of value, most efficient place to park your hard-earned energy, then these numbers seem incredibly realistic and pretty comprehensible, I think.
Yeah. The other interesting thing to note on that slide, below 1x MNAV, they started really highlighting the ability to sell Bitcoin derivatives if they had to. And I think that's important because it got ignored a lot when people were looking at what is the optionality in the event that you've got adverse markets and you've got to come up with a way to generate the capital to meet your obligations. It's always been an option. And I think the first time I ever heard him talk about it, Tim, was actually at your conference in New York. I think was the first time I heard Strategy actually acknowledge that, one of the things we could do would be sell derivatives. They also said one of the things we can do is sell high cost basis Bitcoin, right? I think the market just needs to hear that. And even when you look at a lot of the models, a lot of the modeling that happens in the space assumes that you would have to sell Bitcoin as a part of this, right? It's not your first option. It's not what you're trying to do, but you have to prepare for every market condition you can encounter. You're not just going to live in bull markets. This is a wildly volatile asset. And you might have extended periods where it drags down the common equity, right? If the common equity is amplified Bitcoin and Bitcoin goes into an extended drawdown, common equities suffer, right? That's the engineering here. That's how that works. They're absorbing that excess risk in the common equity. And so you have to be ready for common equity not to be an option for a period of time. And that's what you're starting to see highlighted. It used to feel like it was taboo to even say, right? Nobody wanted to say that, well, you could sell the Bitcoin, right? Or you could sell derivatives. But when you have all of these assets on the balance sheet that are ingrained in the financial markets, you have optionality. I think that's the point of them highlighting this now over and over, and he built it in. I think it was, kind of the biggest booster on the rocket, actually, in the image there. And so they're just showing the market that there is optionality here. When you have $59 billion of Bitcoin and you have to come up with, say you had to come up with $60 million in a month, like, you can do that with $59 billion worth of Bitcoin. The derivatives market would allow for that. And so there's optionality that's out there to let them meet the obligations that is not solely tied to a premium on the common equity. And I think that's the message that they're trying to drive home now. They've alleviated that with the USD reserve, right? They kind of pre-funded, right? They raised the equity capital right now, and they've now set that aside. So they've got that as the battery that's in reserve to be able to pay those dividends. To Jeff's point, if they've got a good premium on the common stock equity, they might still continue to use that and not draw from that reserve at all, because this is a reserve they're intending to maintain, right? So they'll draw from the reserve when the conditions are right to draw from the reserve. And if the conditions are right where they should sell common equity, my hunch is they would still do that, because that would be the better alternative in that situation. But what they're showing now is that there's several options. And so for the market to just focus on the common stock ATM here as the only lever they can pull to meet the obligations, that's just simply not true. And that's what they're highlighting.
I like how he also put it in per day metrics. Like that's something, you know, we've talked about internally. Is like the scale is just not very much, right? If they needed to raise $60 million a month, it's like I think you said in there is $2.2 million a day. Okay, if you need to raise $2.2 million a day and your common equity trades $3.6 billion, I think you're going to be okay. I think you're going to be able to find out, you pull in $2.2 million when your stock trades $3.6 billion a day. And I was just doing some quick math and thinking about it on a monthly basis. If they needed to fund a month's worth of dividends by selling Bitcoin at today's prices at $86,000, it's about like 650 Bitcoin. It's just not very much. It's not that big of a deal. It doesn't really move the needle, and that's assuming all of the dividends pay at the exact same, or you're spreading the dividend equally across all months, which isn't the case, right? Some of them are quarterly, some of them are monthly. But yeah, it's there's so much optionality here within this model. Selling Bitcoin has always been an option, but you'd rather do the 10,000 other things before that. I think the other thing, as you said, Ben, pointing out that the derivatives market is trading $100 billion a day is really fascinating. And several different ways you could do that, right? I mean, now they could consider cash secured puts with a $1.4 billion dividend reserve. They can consider covered calls or something like that in order to generate income. But I think the reality is that now that they've got the cash, they've just preserved all of the options, which should create additional volatility within the stock as well, because you never know exactly what they're going to do. And if they fell below 1x MNAV and you sold high cost basis Bitcoin, you get a tax benefit that you could buy back the stock that increases the Bitcoin per share. There's just so many different things, different ways to think about the construction of the financial engineering. Fascinating stuff.
It is. And I think one of the other messages that comes out of this when you have a reserve is that one option is coast.
Oh, yeah.
I think that one is overlooked.
It's coast.
And that comes with, I think there's to a certain degree, having, weekly metrics come out like Strategy does, where they're making announcements, every Monday. For better or worse, I think it does play a part in conditioning investors to have really short time horizons, because you're constantly analyzing weekly data. So when there's weeks where they come out and they don't have a Bitcoin buy, right, that raises all kinds of speculation. Sometimes it's good because people are anticipating really major buys because of what went on during that week, but it does cause people to really focus on short-term metrics. But I think when you get into certain market conditions as a company, one thing you've got to be able to do is not do anything, right? You have to be willing to coast for a little bit, because you can get some really irrational market conditions out there. But in order to have that even be an option, you have to have these types of reserves, because the one thing you don't want to do as a company is get forced into a decision that isn't the right decision. And that's what happens when panic sets in, and you see a lot of this on social media. When the market starts getting bad, everyone's trying to come up with something that can, fix it in a week or fix it in a day. And you look at a company like Strategy and how well capitalized they are, and you go, one of the options can be, wait, you don't have to do something drastic all the time. And particularly now, right? That's the point of that battery analogy, is you can draw down from that battery if you need to. So you can coast a preserve, and the capital markets might not be in the right conditions to be able to raise capital out of the instruments that you have out there. You may not want to go sell Bitcoin or sell Bitcoin derivatives, and it gives you that optionality. But that requires a long-term focus, right? Because every action that you take has to set you up for long-term value creation. It's very easy to make a small adjustment during a time period where there's heightened emotions and you're getting a huge amount of pressure coming in. from the investor community, but short-term actions can have long-term compounding effects. And so it's important when you're building one of these types of companies to make sure you don't put yourself in a corner where you have to make a short-term reactive decision that can compound over time and take value from shareholders over a long time horizon, right? These are long-term plays. These are plays over years and decades that you're building towards here. And so every slight adjustment in course, can set you on a different path. So being able to sit back and evaluate and see what's happening in the market and see what's really going on and not reacting to flash crashes in Bitcoin or being forced into positions where you have to raise common equity below net asset value because you got to make a dividend payment. You've only got a day to do it. And so you're trying to raise capital. You're just taking that out of the equation and you're allowing yourself that flexibility to operate with long-term value creation in mind. And I think that's something that doesn't get highlighted enough because we do live in an area where we're constantly doing analytics on these companies. You've got all these dashboards out there that are giving investors something to focus on. But it does mean that every single week that new information comes out, people are scrambling for what does it mean and, trying to see what they would have done different. I think that it does contribute a little bit to taking away from what people learned with Bitcoin, which was have a long time frame. This is a long-term investment. You got to think in terms of 4-year cycles, and that applies to these types of companies. So, seeing them establish this reserve, I think this gives them breathing room to make sure that they're in a position where if the right decision is pause, now they can do that.
Yeah. I have a quick question on the USD reserve. Like in your eyes, Ben or Jeff, what are the at least obvious options? And maybe this is like a treasury management, risk management sort of question, and maybe it's down the list. But you could just keep that in a checking account, get no interest. You could put it in a money market or something that you get a little bit of interest. And I figured this question is probably going to come up on social media if it hasn't already. So why not just kind of talk about it a little bit? Because on the Bitcoin front, the big banks are not banking Bitcoin yet. So you have that counterparty risk, but they are banking US dollars. So if you have it at JP Morgan or Bank of America or wherever you are, that's not a terrible counterparty risk scenario, right? To try to get a couple points of interest or whatever. And again, may not move the needle, but when you're talking about $1.5 billion or maybe $2 billion eventually, maybe that, I'm sure these are the conversations that are happening from a treasury management standpoint, if that makes sense.
Yeah, it can be layered into different maturities, right? So if you know that you want to have some accessible within 3 months, you can have that into a 3-month structured treasury product, and then 6 months, and then 9 months, and then 12 months. And you can have different layers that offer progressively higher rate of return backed by USD or US Treasury. So that's what I suspect how they will manage the structure of that. I don't think it'll all be in short-term money market funds. I suspect it'll be kind of laddered out over different periods of time because because you have the benefit of time and you have this buffer. You have this initial buffer. It's a good question. I'm sure, Peter Schiff is already hooked onto that one. He's like, oh, they're establishing a USD reserve and, no surprise there. So, I'm sure they will talk about it within their next earnings call, how they're managing their USD reserve.
Well, you'll see it come through in the financials eventually, right? But there's no chance that this sits in something yielding 0%. Knowing Saylor and knowing how that team operates, I just don't see it. So, Jeff's probably right. With that amount of capital, it's probably being spread across vehicles. And, if they are using things like US Treasuries, then you're probably going to have an amount that's laddered monthly so that they've got capital becoming available when they have monthly dividend obligations and then laddering some out and maybe in 3-month treasuries, or maybe it's sitting in money markets, right? That's going to depend. They have a lot of bargaining power with $1.44 billion. To go find the right account to park that capital in. So, I think that there'll be a lot of institutions, and obviously they've already got relationships with a lot of them that'll be wanting those deposits, and we'll see where they ultimately land. But I think that they would keep it uncorrelated, to anything in the Bitcoin ecosystem. And I think that it'll be fairly vanilla the way that that gets managed, because again, I think that this is as much for ratings agencies and institutions. So they're going to manage this in a way that's understandable to them. And so that's why I don't think there's going to be anything overly creative here. I think it'll just be standard treasury management practices on this.
Tim, this is a really good question. And the reason I like it is because this is sophisticated. Like, when was the last time that any, retail investor or a group of retail investors understands like treasury management and how somebody's managing their cash portfolio and the assets on their balance sheet, right? It's easy to invest in the Mag 7 because you're like, oh, I see more Teslas driving around on the street now. I'm going to buy Tesla stock. Easy. I use ChatGPT every day. Like, who provides the chips for that? NVIDIA. Easy. I use an iPhone. It's like easy to see. But now we're talking about sophisticated finance at the cutting edge, using the most cutting edge asset on the planet, and talking about treasury management and risk. And like, this is really novel. It's not really like, the concepts have been around for a really long time, but this using this asset and having this structure is really novel that many people never even ask about. Like, who knows how much cash Tesla holds? Right? Like, that, nobody cares. Nobody cares. And now you have a structured finance vehicle that's offering these types of products, and people are thinking about this stuff. I think that's just generally good to think about. How do I manage risk structure? How do I you can start to see your own life through the lens of like how this company's managing things. Like, okay, maybe I should have a USD reserve. Maybe I didn't have that previously, and maybe I can emulate that same structure and start to use all of these different products. So it's fascinating to see. And I brought up the concept of solvency a little bit earlier, and they use this concept of life. Right? We have 74 years of life with Bitcoin at its current price, and we could pay out these dividends for 74 years. What other company right now on the planet would you feel comfortable that the company is going to be around in 74 years? Maybe a handful, right? Maybe a handful. And if the price of Bitcoin dropped 50% down to 45,000, like, the company's going to be around for 35 years. Well, again, what other companies do you think are going to be around in 35 years? Maybe two handfuls. That's if Bitcoin doesn't move at all. And I think that message came through here. It's like, here's the math. We're going to communicate this in a way where you can conceptualize it. And I think we'll continue to hammer on that topic.
These companies in general, because these are treasury-based companies, are really highlighting a function that was kind of forgotten for a very long time. Treasury was not the sexy space to work in.
No.
At any of these companies. You just never really heard about it, right? Because you're basically
everybody just gives the dividends back. It's just like, we just dividend back.
Yeah, and you're rolling treasuries and just making sure that capital is becoming available as you have outflows, and you're kind of managing the inner workings, which is critically important. But it just never got it highlighted, right? Because it's not new products hitting the market. It's not the sales, right? It's not the sexy stuff that the market likes to digest. And so this does start to highlight it. But, one of the things you look at this to go, even if they were incredibly boring with this and just put it in 3-month treasuries that are yielding like 3.7% or something around there, just that interest every year would pay 2 months of a stretch dividend. Right? I think that's 20 some million. That'd be, I think that the dividend on that would be 22-ish million a month, something to that nature. And so you'd be yielding, 54 million a year in interest on just parking that in those treasuries, and it covers, 2 months of the stretch dividend obligation. So, you got a little longer runway than what it looks like on the surface when you're just looking at that reserve. So it'll be very interesting to see how they structure this, how they measure it, and then see if this is something that even gets built into their own analytics, right? I mean, you're gonna have to start highlighting this now, because this is going to be a part of that standard business practice. And I think that that's a component of building a good business, right? You don't want the market to have the perception that you're running red line all the time. And they weren't, but the market couldn't see that. But
Yeah.
now the market's going to be able to see that. And so when you're becoming this issuer of these novel products, right, you want there to be stability around your ability to operate, right? You want confidence in that. And this is going to help to build that. This news will take a while to get out. It'll take a while for people to digest. Not everyone's, watching Sailors X Post and waiting for these videos to come out and going through the presentations, right? That's kind of unique to our world. But over time, this will become one of those talking points that gets out there as more of these fear pieces come out and people that are involved in the community start to, educate on what's actually going on, what that risk profile really truly looks like, because it's way lower than what the market thinks it is.
As fiat systems falter, wealth preservation isn't a strategy, it's survival. While the world reacts, Swan Private clients are already prepared. Swan Private builds strong relationships with clients around mutual conviction in Bitcoin's long-term promise. With concierge service, deep expertise, and airtight security, the Swan Private team helps build generational wealth the right way. Swan Private's comprehensive Bitcoin wealth platform serves over 5,000 clients with more than $4.5 billion of Bitcoin purchased to cold storage. Swan Private is built for long-term partnerships. Get started today at swan.com/private. Do you guys want to finish up with the STRC dividend? Hopefully the only outside of Japan rate hike that we'll see for a while. And the question that comes to my mind is, it was hiked up to 10.75%. What realistically could these go to? Because to use an exaggerated example, if you get to like 15%, you're almost entering, I don't know, like a private credit, private equity sort of return. So just interesting to think through.
They got up to 15%. The people collecting return of capital dividends are going to be doing the happy dance if people aren't figuring this out by then. The reality is these ratchet up slowly. And in the early days, the stretch product is pretty mechanical in the way that they manage it, right? I mean, they've put out kind of the guidance on when they're looking at 25 basis points versus when they're looking at 50 basis points. And, so it's fairly mechanical in that aspect. But, to your point around the Japanese bank rates, these are the only rates that investors are cheering for to go up, right? This is the one place where that's an actual benefit to all the investors that are out there. But even at 15%, right, you got to look at what's your assumption. Right, if you're just viewing this very simply as a carry trade, right, you need the CAGR of Bitcoin to outpace your cost of capital. And so if your cost of capital was 15% and your working assumption is that Bitcoin's going to compound at 20%, you're still generating excess value that's passed down to your common stockholders, right? You're generating 5% in that scenario that goes down and attributes excess value to your common stockholders outside of the general returns Bitcoin. So it really does become what's your assumptions on the growth rate in Bitcoin? And that's one that investors need to answer for themselves. The companies are usually fairly transparent in what they're thinking and what they're modeling. And when you look at the historics, that gives you kind of a barometer that you can look at. But that's the play here, right? You want the compound annual growth rate of Bitcoin to outpace your cost of capital. And in the event that it does, which is kind of that cruising speed or whatever the metric was, I'm going to have to refamiliarize with new metrics all the time here. But, they're showing how little Bitcoin needs to perform to generate excess value that creates that amplified return to the common stockholders. So, we'll see over time. We're still in year one here. These are still products that the market's very much figuring out as we learn, every day that we log on to Twitter. And over time, as there's more liquidity, I think you'll start to see a lot more stability come here. That's the one component of these products that I think is underappreciated right now in the market is the focus that companies need to put on building the liquidity profile of their products. You want your products to be able to trade very freely in the market. So as strategy gets bigger and bigger and bigger, right, they refer to Stretch as kind of their treasury instrument. Well, if I've got a treasury that I want to put in $200 million into a product like this, one of the things that I need to look at is, well, what's my impact going to be in the event that I do need that capital out of that product, right? And that's where liquidity comes in, right? The more shares that are trading, the more scale that you have out there, the bigger the types of capital can come and invest in that product. So we're very much in the building phase of these products. Like I said, they just came into existence 9 months ago. But as the market starts to understand them, and particularly, I think, as the market starts to digest the tax benefit of these products, you're going to see more capital coming in. You'll see more capital raised by the companies. You'll see liquidity boost in these products, and then you'll be able to see bigger and bigger participants be able to take positions over time. So, there's a lot that's in front of us here as an industry. You're going to see more companies come out. You've got MetaPlanet. Obviously, they did their initial pre-IPO round that they did. And so they'll get theirs out there in Japan. This is going to create more global awareness of what digital credit is. And to me, that's the best, is that message gets out worldwide, not just in the US, right? It's starting to get out worldwide, which helps with that education aspect. And that ultimately is going to bring a lot of capital both into these products and then into Bitcoin as well.
Yeah. Great to see. I mean, just 10.75 is very lucrative compared to the 0 I'm getting in my checking account. Or, Ben, you brought up the comparison on your choice of compound annual growth rate. I'm just going to share my screen one more time. And I think this is something that people spend a lot of time looking at, is the 4-year compound annual growth rate chart. So you look at this orange line over time. So this is tracking the 4-year compound annual growth rate. And you look at, as of today, you'd say the 4-year compound annual growth rate is something around 12.9%. But the interesting thing is, if you're underwriting Bitcoin risk and you're underwriting future returns and Bitcoin returns, you want to compare what was the capital environment like, or what was the interest rate environment like? What was money supply doing around that point in time? And the relative reference point that we have is November 30th, 2021. So this is before interest rates were hiked back up. This is right after capital's coming into the market, a ton of capital's coming into the market, and the price of Bitcoin is at $56,000. So the reference point on the 4-year annual growth rate is actually pretty high. So what do you know, if you look at what the price of Bitcoin did over the next 12 months here, going down to November of 2022, it drops down to 16,000. So the relative reference point, the 4-year compound annual growth rate. So this chart, this orange line, Bitcoin were to stay the same and not move at all, the orange line is going to start going vertical in the inverse fashion of the Bitcoin price going down. So if you were underwriting a long-term, view or CAGR of the price of Bitcoin, that relative reference point changes maybe how you look at the data. And if we think that, quantitative tightening just stopped, we've got a new Fed chair in 2026, running into midterms, the speculation on the economy, and some potential loosening of monetary policy, that could accentuate this 4-year compound annual growth rate chart. So yeah, it's we're at a unique point in time. The reference point is going back to all-time highs of prior cycles, and there's been some bearishness around the future pick of your Bitcoin price. But if you use $17,000 as your base, if the price of Bitcoin is $64,000, that's a 40 CAGR over the last 4 years. So there's some wiggle room in expectation and future underwriting of annual rate of return there. But that's all I got. That's pretty much it. And I guess my final thought, if I've got to put this out there, I've been thinking about this a lot. Bitcoin is really this instrument that is really attractive to millennials and my generation. I've talked with some friends over the holiday break, and it was fascinating seeing how more open to Bitcoin they were this Thanksgiving than periods in the past. And the reason for that was frustration with housing prices, frustration with equities. I'm not going to buy bonds. How do I buy private equity? Can I buy private credit? I don't know how to do any of those things. And this is an option. And it's an option where you can feel like you have an edge, and it's a a digital, it fits with how we grew up. Like I grew up with a computer in my hands and like playing on computer games. Like I taught my parents how to use a computer. And that was a bit eye-opening. And it's funny too, on X, a lot of people are calling for like housing price crash, or I'm just waiting for a housing price crash. What would cause a housing price crash where you maintain your job? I think a lot of people, like the younger generations, I've contemplated this with them. Like, what would cause a housing price crash where you feel comfortable, like you can buy a house? And that was a light bulb moment, like an aha moment of, oh wait, yeah, this might not stop. Like this train might not stop at all. And you need to figure it out. If that train's not stopping, what do you do? And that's it.
And it is the problem though, right? I mean, that's when you keep seeing the longer and longer mortgages and you just spread those payments out longer and longer. And pretty soon it feels like everyone's going to get a coupon for one lifetime mortgage. You have to go buy your one house, and that's where you're going to have to stay, right? Because they're going to do anything they can to prop up the housing market. They're not going to let that one fall off, at least not without a fight, right? Something systemic has to break to get a major correction out there. So we'll see. But to your point, I think people do start to wake up. I do think that there was a severe lack of hope out there for a lot of people. You know, we're in a pretty privileged ecosystem here, but I think when you get back out there around the main street, you start hearing what those struggles look like, right? Those people don't have time to be on Twitter, you know, debating whether ATMs are good or bad, right? It's a very different scenario out there. So, you know, the awakening to Bitcoin, I think, is coming at the right time. I think that we've had enough angst in society where people are willing to become more open-minded because they look at the older system and they say, well, that's what got us here. So what can we do differently? You know, and Bitcoin fits into that category. So I'm incredibly optimistic. You know, I think, you know, to the point that people have brought up a lot, people find Bitcoin when they need to find Bitcoin. And right now, I think that there's a lot of people that need to find Bitcoin. So, you know, it feels like we're reaching that moment. I think bringing these types of digital credit products, you know, into the equities market here, where people can go get easy access to them and then learn what's powering them and how this is being made possible. I think that just helps to push that down the road, and hopefully, you know, more people can find more hope in Bitcoin here moving forward.
Absolutely. My final thoughts are what I posted on X today, which is I'm dedicating my life to Bitcoin and a USD reserve. I'm all in. For Jeff Walton and Ben Workman, I'm Tim Kotzman. Thanks for listening and watching The Hurdle Rate, episode 38. We'll see you next week.